Bismillahirrahmanirrahim. Dear student, today we'll start the next part of our foreign exchange risk chapter. So far we have discussed certain aspects of foreign exchange risk, and we have already discussed that there are different type of exchange rate systems like a fixed exchange rate system, flexible exchange rate system, and managed exchange rate system. Moreover, we have also discussed certain types of risk transaction risk, economic risk, and translation risk. Over here, I will be giving a brief overview of different type of risk, and we will then move on to next topics. First of all, what is foreign exchange risk? When we talk about foreign exchange, it can also be known as exchange rate risk or currency risk. Currency risk or exchange rate risk comes when you are working in international market, or you are involved in trading activities, or you are involved in investment in different countries, or we can say that you are working as a multinational business. So a this is a financial risk posed by an exposure to unanticipated changes in exchange rate between two currencies. Like when we are working in international market, so obviously there are different factors, different events, or different changes which cannot be expected, so that might have impact on the currencies of different countries. And while you are working in international markets, so you are constantly are in exposure to this kind of risk, because it might impact your currency, or the currency in which you are exchanging your currency, or the currency of the countries with which you are trading. And mostly investors and multinational business exporting or importing goods and service, or making foreign investment throughout the global economy are faced with an exchange rate risk, which can have a severe financial consequences if not managed appropriately. Like अगर हम यहाँ पे देखें ना, तो ये असल में वो लोग जो अपनी कंट्री में बिजनेस नहीं कर रहे, बल्कि अपनी कंट्री से आउट जा रहे हैं, और वो इन्वेस्टमेंट भी कर रहे हैं. वो ये भी हो सकता है कि मुख्तलिफ कंट्रीज़ में अपने उन्होंने ऑफिस बनाए हुए हैं और मुख्तलिफ कंट्रीज़ में ऑपरेट कर रहे हैं. वो एक्सपोर्टिंग में भी इन्वॉल्व हैं, और सर्विसेज प्रोवाइड कर रहे हैं वर्ल्ड ओवर, और मुख्तलिफ किस्म के फॉरेन डायरेक्ट इन्वेस्टमेंट या फॉरेन इन्वेस्टमेंट थ्रू आउट द ग्लोब जो है वो कर रहे हैं. सो क्योंकि ये एक करेंसी में काम नहीं कर रहे, डिफरेंट करेंसी में काम कर रहे हैं, सो ये वो लोग हैं जो इस फॉरेन एक्सचेंज रिस्क पे एक्सपोज होते हैं. So there are different types of foreign exchange exposure or risks, like transaction risk, economic risk, and transaction risk. So I'll be giving a brief overview of these three type of risks, because we have already discussed in the previous class. So first, transaction risk. When we talk about transaction risk, it is the risk which might a foreign investor, or the person who is involved in foreign currency dominated transaction, is confronted due to changes in the value of currency. And it's very important for the person who is involved in these type of transaction to convert the foreign the cash flows which is dominating in foreign currency into domestic currency, to see the impact of movement of exchange rates. Like for example, if exchange rate move up to 10% in a single year, it has a significant impact on cash flows, meaning a 10% decline in the receivables, or 10% rise in the value of payable. So such outcome could be troublesome, as export profit could be negated, because you are doing business, or you are exporting certain goods in order to generate some profit, but in that case you will not be able to generate any profit, or it might be possible that you are confronted with losses, or import costs would be rise substantially. So it's very important that when you are involved in foreign currency transaction, you should understand what are the risks associated with that, and make certain arrangement for reducing that kind of risk. The second type of risk is economic risk, and when we talk about operating economic risk, it is a variation in the value of the business due to unexpected changes in the exchange rate. Or in other words, we can say that it is a long-term version of transaction risk. Like consistently you are making transaction and you are doing business, and consistently it is impacting your the value or the business value of the company. So it can also be called as operating exposure, and this kind of risk this kind of risk is involved with, and it shows that the degree of the degree that the market value is influenced by expected exchange rate fluctuation, like that how your market value is change, increase or decrease due to changes in the exchange rate fluctuation. And such exchange rate adjustment can severely affect the firm position with regards to its competitor, and because in the market you are there to beat your competitors. And if you are not in a good market position and you are losing your market value, so you would be had a weaker position against your competitor, and the firm future cash flows will also be declined, and ultimately it will impact the value of the firm. So a firm's economic exposure depends on the structures of the input and output markets. Like the input means that what kind of raw material you are putting in, whether you are taking this inputs from your domestic market, or whether you are importing these exports, or output markets means that where you are exporting, whether you are introducing your product in the foreign markets, or you are you are only involved in importing raw material from outside and introducing or offering product to the domestic market. So it depends upon that. And a favorable and long-term solution of this type of risk is to diversify all aspects of the business. Like you can have different markets, you can get inputs from different markets, and you can offer your outputs to different market as well. You can so it will aggregately decrease your economic risk. Now the third type of risk is a translation risk, and when we talk about translation risk, we are actually talking about the balance sheet and income statement figures of the company. Like when you are working in the as a multinational company, and your head office is in one country, so obviously the company has to consolidate its earning from different countries, and they have to convert the currency into their home currency. So a firm translation risk is the extent to which its financial reporting is affected by exchange rate movement, and the exchange gain or loss occur from different in exchange rate at the beginning and at the end of the accounting period. Obviously most of the time the financial reporting is done at after 1 year. Annual reporting is done, and after 1 year. So if there is a significant difference in the exchange rate between the year, so it definitely impact the values of assets, liabilities, and many other financial reporting items. So a firm is exposed to translation loss if it uses current exchange rate to translate its asset and liabilities. And when you are using your current, obviously current exchange rate is if it is being used, so it has impact on the values of the assets and liabilities and many other aspects of the items of the accounting, financial reporting and accounting aspect of the company. And this translation risk is also known as accounting risk, as rather than a cash based risk. Now, when we talk about the foreign exchange market, so in a foreign exchange market, we have two type of prices, bid price and offer price. and mostly banks are there to deal in foreign currency, so they actually quote two prices for foreign exchange rate, and a lower offer price, like they can buy foreign currency on lower prices and a higher bid price, and sell the currency on a higher price, and the difference is the profit of the bank. The bid and offer price can be explained with the help of an example, like the US dollar rate per pound sterling is quoted as dollar 1.4325 to 1.4330 is equal to 1 pound. Company A wants to buy dollar 1 lakh in exchange for pound sterling, and company B wants to sell 1 lakh dollar in exchange for pound sterling. What rate will the bank offer to each company? If we look to the answer of this question, like company A wants to buy dollar 1 lakh in exchange for sterling, so the bank would be selling dollars. If we use lower rate of 1.4325, the bank would sell them for 69,808 pound sterling, and if you use the higher rate of 1.4330, the bank would sell them for 69,784 pound sterling. The spot and forward market. The spot market is that market where you can buy and sell a currency now, like the current rate is prevail in that, and you can exchange your currency if you want to buy, or you can sell your currency. You can sell it at a current rate. But in a forward market, where you can buy and sell your currency at a fixed future date, but the rate is predetermined, and this can be done by entering into foreign exchange contract. Like अगर हम देखें तो स्पॉट मार्केट जो वो मार्केट है जिसमें आप आज के रेट के ऊपर अपनी कोई भी करेंसी खरीद या बेच सकते हो, लेकिन जो फॉरवर्ड मार्केट है वो मार्केट है जिसमें आप अपनी कोई भी करेंसी बाय और सेल करते हैं, कि प्रॉमिस करते हैं कि फ्यूचर में उसको बाय करेंगे या सेल करेंगे, लेकिन वो रेट जो आपने पहले से डिटरमिन किया होता है, और ये उस वक्त करते हैं जब आप जो है वो एक कॉन्ट्रैक्ट कर लेते हैं अपने जो भी बायर एंड सेलर है जिसके साथ भी आप कर रहे हो, तो उसकी बेसिस के ऊपर फिर आप जो है वो अपनी करेंसी को एक्सचेंज करते हैं. Now, why exchange rate fluctuate? There are a number of reasons behind the fluctuation of exchange rate. The main reason behind the fluctuation or volatility of exchange rate is balance of payment. And balance of payment is directly associated with international trade. That net amount we pay for our imports and net collection which we get from our exports. Because we need currency to finance our international trade, and these changes in trade leads to changes in exchange rate. For example, if we are importing more goods from outside, and that will increase the supply of home currency, because we have to sell our home currency in order to buy the foreign currency, to pay the supplier, or to pay the foreign supplier, and it has a negative impact on our exchange rate. And vice versa, like if we have to if we are exporting more goods, in that case the demand for our currency increase, because the foreign purchaser has to purchase our currency in order to pay us. Exports have a positive impact on our exchange rate, and more imports have a negative impact on our exchange rate. Another aspect which has a potential impact on currency exchange rate is the capital movement between economies, the inflow of capital within the country and outflow of capital outside the country. And if there is more net outflow of the currency, it has a negative impact on our currency, and it depreciates the value of our currency. There are several factors which lead to inflow and outflow of capital, and which include interest rate and inflation. Like when we talk about interest rate, when there is rising interest rate in other country, so obviously capital flow out that country, and the demand for the currency will increase, because you want to invest in that currency. On the other hand, inflation also causes changes in the currency exchange rate, like asset holder will not wish to hold financial asset in a currency whose value is falling because of inflation. So these are the major causes which can result in inflow and outflow of capital within our country, and it has an impact on the value of our currency. The other causes of exchange rate fluctuation, we have different theories. In this lecture, I will be discussing purchasing power parity, and the other three theories will be discussed in the next week lecture. First of all, we talk about purchasing. The purchasing power parity is theory which states that the rate of exchange between two currencies is actually dependent on the relative inflation rates within the respective countries. Like the exchange rate is dependent on the purchasing power, like because inflation rate is something which can decrease the purchasing power of that country. So mostly the exchange rate is dependent on the relative inflation rate between these countries, and but this theory is actually dependent on the law of one price, which state that in state of equilibrium, like when there is no transaction or transaction cost or trade barriers between different countries, so identical goods must cost the same regardless of the currency in which they are sold. This is actually the law of one price, and this states that the identical goods have same price in different countries, and the major difference is due to the inflation, the inflation between the countries. So this theory can be explained with the help of this example. Like an item costs $3,000 in the US. Assume that the sterling and US dollar at purchasing power parity and equilibrium at the current spot rate of $1.50 is equal to £1 sterling. That the price multiplied by current spot rate of 1.50 is equal to dollar price. So the spot rate is the rate at which the currency can be exchanged today. Now, cost of item now is in the US market is $3,000, and in the UK market is $2,000 by seeing the exchange rate of 1.50. And estimated inflation is 5% in US market, and in the UK market the inflation is 3%. So cost in 1 year is $3,150 in US market and 2,060 in the UK market. So the law of one price states that the item must always cost the same. Therefore, in 1 year, $3,150 must equal to £2,060, and the future spot rate can be calculated by dividing 3,150 by 2,060, which will give the exchange rate 1.5291. So with the help of this, we can also determine the future spot rate of the currency. Now the calculation of future spot rate can be done with the help of this formula, like S1 is equal to S naught multiplied by 1 plus HC divided by 1 plus HB, where S naught is current spot rate, S1 is expected future spot rate, and HP is inflation rate in the country for which the spot rate is quoted, and HC is the inflation rate in which in the other inflation rate in the other country. Now this can be explained with the help of example, like the dollar and pound sterling are currently trading at $1.73 is equal to £1, and inflation in US is expected to grow at 3% per annum, but 4% per annum in UK, and they are asking us to predict the future spot rate. 1.72 is the current spot rate, and 1.03 is the inflation rate in the UK, in the US, and 1.40 is the like we have taken 4% inflation rate in UK, and the answer is 1.7035 is equal to £1. This is the future spot rate for US and US dollar and UK pound sterling.